Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. All right, hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review, follow it wherever you're watching or listening to it. With me today, I'm happy to have on for the third time my friend Yaron Naymark. Yaron, how's it going?
Hey, I'm good. How are you?
Doing great. Great to have you on. Yaron, I should have said it. He's the founder of One Man Capital, good friend. I think he's a super smart guy. Always happy to have him on. Just before we start talking, Yaron, let me just give everyone the disclaimer I give at the start of every podcast. Nothing on this podcast is investing advice. That's always true, but particularly true today. We're going to be talking about Limbach, which is a sub 250 million market cap company. You know, obviously at that size, at that scale, at that liquidity, a little bit of added risk. So everybody should just remember that. And please keep in mind, not investing advice, do your own diligence, do your own work, all that type of stuff. But speaking of do your own work, I know Yaron has done tons of work on this company. You followed these guys for what, 4 or 5 years, something like that. I can remember talking to you about them in 2020. You've gotten out, you've gotten back in, but we can talk about all that. But I'll pause there and just say, Limbach, LMB. What is Limbach and why are they so interesting today?
Yeah, so I've actually been following them since they came public via SPAC. So like I remember all do your own diligence, not investment advice, like layer on the fact that this came public via SPAC in 2016. I
remember the early SPAC mafia in 2016, 2017, where it was all over Limbach and the Limbach warrants. And yep. I remember those days.
Yeah. And by the way, those warrants, like, they were down, all the way through the fourth quarter. And with 2 minutes left in the fourth, they came back and went from being out of the money and never going to have any value to now having value. So anyone who owned the warrants has done really well. But yeah, I followed it since 2016 from afar. They came public. They're a mechanical system solution engineering company. They focus on HVAC systems, but they do some other mechanical stuff as well. And they focus on the HVAC systems mostly in commercial buildings. Historically, when they came public mostly selling new construction work through general contractors. And the thesis was you can roll up this industry at very low valuations, call it 4 times EBITDA, and grow this thing, get some geographic diversity, customer diversity, and create a lot of value through accretive M&A. Selling work through general contractors is a pretty bad business. It's these are long lead time projects where you're installing HVAC systems and new construction projects. You have to quote and bid on the work, and then it's could be a multi-year project where you're relying on other parts of the construction to be completed when they're expected to before you could start your part. In the meantime, you're like engineering it, prefabricating it in your facility. You're spending money, you're not getting paid yet. So you're building up inventory and receivables basically. So it's very working capital intensive. And in the meantime, you could have like cost inflation, but you already gave a fixed price. So you could get underwater, and the projects could have delays and overruns on, not only cost, but also time. Time is money. And so like the variability in the margin profile of work through the general contractors is high variability. It's low margins, just a bad business. And the company kind of blew up a few times on guidance, where they gave guidance, they missed guidance and had to guide down significantly because of this general contractor work. And so like it wasn't a good SPAC, roll up. They weren't able to do acquisitions because obviously they had capital issues due to these blow ups, and investors got frustrated, and it kind of became an orphan stock. I got involved for the first time as a special situation investment in 2020. When during COVID, obviously HVAC systems became very important for hospitals, for lots of buildings, because everyone was worried about COVID. They got some government work, they got a lot of hospital work, but the stock had traded down. They had some debt The stock had traded down to distress levels. And I think it was sub $3 and the warrants were in the pennies. And it became very clear that they were not going to be distressed because this work was coming on and they were protecting margins. They were able to take some costs out of the business. And so I got involved in 2020 as kind of a special situation, did really well on it in 2020, and was planning on holding it for this transformation into what it is becoming today, which is selling less through general contractors and more directly to building owners, less new construction, more maintenance, service work, small upgrades to your systems, right? HVAC systems are probably the biggest source of, or the biggest use of electricity in buildings. So if you have an efficient HVAC system, you could save a lot on your electric bills, you become more ESG friendly, and you could do work for building owners to help reduce their energy costs, make them more ESG friendly, make their systems more reliable, especially if you have mission critical infrastructure like data centers, hospitals, biotech, research facilities. You can't really have your HVAC system go out at 2 a.m. on a Saturday and wait until 9 a.m. on a Monday to get it fixed. So if you have mission critical stuff and you're a trusted service provider to, if Limbach could become a trusted service provider to these building owners with mission critical infrastructure, they could start doing more service work, which is not only much higher margin, it's less working capital intensive because shorter projects, you do the work, you get paid right away, you don't build up inventory and receivables, and you don't get stuck with these cost overruns and just variability in margin. So it's higher margin, more predictable margin, lower capital intensity. It's just a better business. And so while I made a lot of money kind of on the trade, the special situation trade of this is not going bankrupt right now, it's a going concern, it got revalued. I still thought there's another huge opportunity of transitioning the business more towards owner direct work, and then continuing using the cash that the business is now throwing off because it's more predictable to roll up the industry at really attractive multiples, right? You could do acquisitions here at 4 to 5 times EBITDA, which is a really attractive, for business with almost no CapEx, that's an attractive acquisition multiple. In the meantime, you're diversifying the business. Through acquisition, you're getting bigger, and a more diversified, larger business would be worthy of a higher multiple. So not only would you be making the business more predictable and growing earnings and free cash flow per share organically and via acquisition, but you would probably command a higher multiple in the future. And this was trading really cheap still. I got a little frustrated with a few things that management did, in particular an equity raise they did, which, the way they did it and the amount they raised, it just, I think they pissed off a lot of their shareholders, including me. I decided it wasn't an investment for me anymore. It was just, it was a trade that I did well on, that I gave back some of the gains on, and I exited the position. But I kept following it on trades where you make a lot of money, especially you kind of have an affinity for the company and you want to see what goes on with them and you're curious. And so I kept following the company. They replaced the CEO earlier this year. And I made it an investment. I think it became an investment once again for me, not just a trade. And I've been in it since January in size. And I think since they came public, they've taken their owner direct gross profit mix from a third. It used to be 2/3 general contractor, a third owner direct, and today it's the opposite. It's 2/3 owner direct, a third general contractor. So the mix has improved. Their EBITDA margins have doubled from like 3.5%. When they came public to about 7% today. I think over time, the opportunity is to take it to a low teens EBITDA margin as they continue mixing the business and doing some M&A. So I think there's lots of room for the margins to continue to expand. The stock is still very cheap relative to comps. It trades at a single-digit free cash flow multiple, 6 times EBITDA, net cash balance sheet. And so they're going to be able to do a lot of M&A. It's getting added into the Russell now, so there's going to be some passive buying. So there's just a lot of great angles here. It's becoming a better business, a larger business. And so excited to talk to you about it today.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are. And you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. Well, look, I think you just hit everything about it. We can probably wrap the podcast up here, but I'll try and earn my keep. I guess the first thing, so I look at this business and, they've got as you said, they've got the old general contractor business, which they're trying to kind of move away towards the owner direct piece. And It makes sense. I agree, right? The owner direct piece, less inventory, less cost overrun risk. You've got that direct relationship, as you said. And I think they actually give the example on their calls. They say, hey, this is a business where something breaks Saturday, 2 a.m. You're not going to wait till Monday. I guess my first piece is, okay, it sounds really nice, but everybody says they want to transition into a better business. Like, to me, it does seem like this is a business like mom and pop down the street can try to do it. Maybe like a one-person shop can't, because you can't be on call 24/7 all the time. But what is their edge in kind of transitioning to this versus, the hundreds of HVAC owner repairers in New York or Chicago or wherever they're competing? What is kind of their edge that lets them do this?
Yeah, so Limbach tends to not operate in these big primary markets. They had an LA.
I saw they closed LA down.
They closed LA.
Yeah.
They tend to be in these secondary, tertiary markets that still have growing populations and good economies, but where they could be kind of the number one, number two player in those local markets. They've been around for 100+ years. They're trusted within their local markets, and I think developing a relationship with building owners, giving them advice, showing up at their location, and just saying, hey, let's work on a plan together to help improve your energy costs, to help make sure we can extend the life of your equipment. And when you're ready to do a new project, we can be there and quote it for you. And I think holding their hands and becoming a more trusted kind of consultant to the building owners is what makes them a better business over time. The OEs also do this a little bit. The OEs, it's not really their primary business. Their primary business is to sell new equipment, not to help extend the life of equipment. And so I think if you're focusing on doing the right thing for these building owners instead of just trying to sell them this expensive equipment, I think you can become a trusted kind of partner to these.
It does remind me of, and this, it was like percolating in the back of my mind, but I didn't get in my notes. But now that you said, like, if you ever look at an elevator manufacturer, what is it? It's like Tyson Krupp or whoever, the best part of their business. Yes, they sell the elevator, but that's not actually where the money is made. Now, elevators are different than HVACs, but it's the elevator. All their money is made on, they get like a 20-year service contract on the elevator. And that is money, good revenue, right? Nobody's going to stop paying to maintain their elevator. So that's where all of their profit is made. And as you said, an HVAC system, like, you sell it, but you're going to sell hundreds and thousands of those HVAC systems, and you probably can't service them all. So it is probably going to these guys.
Especially,
I do hear you on
secondary markets, right, where you might not have a lot of density of your service network.
Yep.
And yeah, even if your primary focus is the HVAC system, it's not necessarily to come and be like, how can we save you money? How can we extend the life of this? And when you're ready for a CapEx project, how can we be, the guy that you want to go to? So a lot of their, even new construction work now, their customers that are building these relationships with them are going to the general contractor and saying, hey, we want you to use Limbach for the HVAC portion of this new project, which obviously allows them to price at more attractive margins for that business as well.
Let me just ask this in a different way. So part of the story is, right, they trade for 6 times EBITDA and maybe 8 or 9 times free cash flow. And we can talk about multiples and peer comparisons in a second. But part of the story is that they're pitching that you're thinking of is, we're going to grow through acquisitions. And I always really struggle with growth through acquisition stories, because it does rely on, right? Like, hey, if we're going to grow on acquisitions, well, we're assuming you're going to grow profitably through acquisitions. And it kind of assumes that the sellers are going to give you a deal when to grow profitably. And there's 2 ways you can do that. A, you think about classic M&A where there's just massive synergies, cost synergies, right? I buy the station next door. We can fire all of their accounting teams. If it's a TV station, we can get better retrans on cable stations. That's not really the case here. I was looking at their last merger call, and they were really clear. Hey, I think the quote was, there are limited cost synergies here. They were like 1 or 2, but it's not about cost synergies. They were talking all about, hey, we're going to use this to find some revenue driven. The quote I have is, front-end revenue-driven sales, business development, marketing synergies, which I don't even know what that is, but I do worry. It's like, hey, this trades for 6x. They want to go buy stuff for 4x and create value. But why are the sellers selling for 4x? Why is that going to create value if there's not really these cost synergies here?
Yeah. So for one, I think the businesses they're buying are just small businesses, and that tends to be the market price, right? If you're getting closer to retirement and you don't have a kid who wants to take over your business and you want to shop your business at this scale, not just in this industry, but in lots of industries, businesses trade for lower multiples when they're smaller. And this business specifically gets lumped in with these construction related assets that people are generally more skeptical of, right? What does the seller know? There's variability in margins here. People tend to be scared of these types of assets. I think, LMB has shown an ability to, with one acquisition since they've come public, but it's been a very successful acquisition, to buy an asset and be the right steward, kind of the Berkshire Hathaway. If you're a seller and you care about, right, you're not going to, the seller is kind of, if they've built this business for a long time and they have a relationship with their employees, they don't want to sell to someone.
It does sound silly. Like you and I are sitting here in like one man shops, it's just my podcast, me, and I think Penny's behind me for people on the video, but I don't have any place. But as you said, if you're a seller, you're selling your business, you built it for 30 years. You've got guys who've been with you 5, 10, 15, 20 years. You do care about if you're selling to a private equity firm who's going to fire your best friend or the guy whose kids you've seen grown up, or if you're going to sell to Limbach who says, hey, it's going to be mainly business as usual. Maybe we even improve the business. Like that stuff does matter. I think
improving the business is by implementing best practices, how to maintain and develop these relationships with building owners and help grow this owner direct type work so that you can, say no to construction work that isn't priced to margins that are appropriate, and just improve your business mix such that gross margins, mix higher. This business used to do a consolidated low double digit, call it 10% gross margins. And now it's over 20% gross margins. I think you could probably get it into the high 20s or low 30s over time as you continue mixing the business. Even within the owner direct work, there's two types of kind of projects. Within owner direct, there's more CapEx oriented projects and more OpEx oriented projects, more maintenance related stuff. Consulting related stuff, and within the owner direct, owner direct is already kind of 2.5x the margin profile of the general contractor margins, but within that, the operating expense stuff is even higher gross margin than the CapEx stuff. And so as you continue mixing the business towards owner direct, which you could do with acquisitions as well, and as you continue mixing it within owner direct to the higher service, higher value add stuff, which there's a lot of corporate know-how, right, that you can kind of implement best practices and send them to your local markets. That improves the business. And, right, a single business, by definition, is just when we spoke about RCI, we talked about this as well. I think a single business just has less geographic diversification, less customer diversification. And so it's just worth less. It's a riskier cash flow stream than when it's owned by a parent that has natural diversification within it.
I'm laughing because RCI was actually the next thing I was going to mention. And yes, it had that. But the other thing is, and this is kind of not common because I know some of your other investments and not all of them have this, but RCI in this, and I think it's something you look for. Look, they're small enough where they can go buy those mom and pops that might trade for 2 to 4 turns cheaper than, the small private equity owned business. They're small enough where they can buy those and that budgets the needle. And they both also have some, I'll call acquisition hair, where like your traditional private equity players might not want to play in that space. I mean, obviously Rick's with, not many investment committees are okaying strip club purchases these days, but Limbach, smaller, touches construction. On the GC side, they've got cost overrun risk. They're obviously trying to switch more to the maintenance type contracts, which, everybody wants those, but it's still got the construction. It's still smaller. It's still macro exposed, quote unquote. It is something that I can see a lot of private equity firms just instantly vomiting on themselves and passing instead of really wanting to, especially at this size. Yeah.
And that's exactly right. I mean, if you're ever going to buy anything for 4 times EBITDA, you're talking about for a business with minimal CapEx, which this business does, you're talking about a 25% pre-tax return on your investment, unlevered. You have to start asking yourself, why am I able to get that? And if you can get it for a reason that makes sense to you, that you're generating excess returns without taking on excess risk, I think it's an interesting situation. the best situation is when you could buy into the platform at a low valuation that can then deploy its cash flow at those attractive valuations, because then you can get a double whammy of the accretion, the earnings growth, the free cash flow per share growth from deploying your capital into those acquisitions, and the benefit of getting multiple expansion on the platform over time as it scales and as people get more comfortable with it. And that's how you end up with an RCI going from $15 a share to $75 or $80 a share. And that's how you end up with LMB, going from, $3 when it was in 2020, low double digits earlier this year. I really believe this could be a $75, $80, $90 stock in a handful of years. And some of that is through earnings growth, and some of that is through multiple expansion, of course.
Let me ask one more on these kind of like maintenance contracts, or hey, we're going to have you on call to come repair the AC at 2 a.m. or something. Is that also something that a mom and pop? It's tough to say this because Limbach is not really acquiring in markets, so they're going to enter new markets. But is that something that mom and pop might have more trouble offering than like kind of a corporate with that corporate knowledge? Or is Limbach generally going and buying mom and pops that already have those maintenance contracts in place? Does that make sense as a question?
Yeah, I mean, if you have multiple employees, it's generally easier to be available all the time, for sure.
Yeah.
And you have the ability to take on multiple projects at once, right? If you have multiple customers who have issues, and you have the ability to service a single customer in multiple markets, right? HCA, which is a customer, Hospital Corporations of America, which is a customer of LMB, like they trust them and they're using them in many markets at once. A mom and pop can't offer that. I'm sure there's some purchasing, obviously, synergies from having scale. But I think it's mostly just being trusted, having your operating history there, and having a staff that can support, customers with multiple locations.
Let me just data centers. So, we've mentioned a few times hospitals, data centers. These are things that 2 a.m. on a Saturday, HVAC breaks.
Disney, NASA, stuff like that.
Just data centers were the one I wanted to think, because these are big things. They are generally, they're really big. They're making a lot of money. Why couldn't they have why do they need to outsource this? I guess is my question. Why don't they have one person who's handling all operations, and internally anything that goes down 24/7, they can fix it?
I think their utilization would be too low. I think their utilization would be too low. It would end up costing them more than having someone who's focused on this 24/7, who has all the expertise, the engineering expertise, the prefabrication, the on-site, the ability to, source whatever materials are needed to fix something, instead of having all the inventory. Like if you own a data center, what are you going to have? You're just going to carry inventory for repairs on site and have one person who might not be doing any work at certain time, right? If you want someone sitting there at 3 a.m. ready to take your call, who's dedicated to your facility, that's going to cost you money all the time. Every night at 3 a.m. you're paying for that person to be available. With LMB, it's not every night; it's as needed, but they're available.
Is there a way to measure local market share?
I don't think so.
Let me ask you. I'll ask you a separate question, then I'll come back to that. When LMB has this, we're on call 24/7. You call us, we'll come. They're not getting a retainer fee, are they? They're only getting paid when something.
No, they're ingraining themselves in the building owner's phone book for when work comes up. They're the trusted guy who gets the work. And so the owner is just less price sensitive in that environment, right?
Yeah.
Now, if you're trying to extract way too much value for yourself, if you're bidding, 2x the price of someone else, I don't think the owner will have that loyalty to you. But that's not the case here. You can provide good service and charge a little bit more and still do much better.
See, it does seem to me like something where, as you said, if you're in a secondary or third market where you could get economies of scale, like, hey, everyone works with us because, as you said, you need somebody on call 24/7. You can only do that with a huge book of business, especially on weekends and late nights and stuff. So we can get there, and our customers, it's Uber surge pricing, right? Your HVAC breaks at 2 a.m. on a Saturday. You can pay us 5x the regular rate now, or you can wait till Monday and we can send someone out there. And I do think that is something. There's probably in a secondary market, 200 people who need 24/7 coverage of their thing, because a house does not need 24/7 coverage. Even if my AC broke, it would be an emergency to me. But if there's 200 people in a secondary market, that's really only enough to support one person paying 4 people, to cover a whole week or something. So it does seem like there could be, hey, we have 100% market share in these third markets. We're the only player. We have 2 people on call at all times, so we can always service people.
I would guess the market share for owners of infrastructure, mission critical infrastructure within markets. I would guess the market share is pretty high for LMB within their local market. So, I've asked them recently, I'm like, hey, if office buildings are troubled, is that going to impact your business? And they're like, offices aren't really the kind of mission critical infrastructure asset you would think of that needs to have their HVAC fixed at 2 a.m. on a Saturday. We don't have a lot of office exposure in our portfolio. So again, it's stuff like the data centers, hospitals, stuff like that. And yeah, I think within that core customer base, I think their market share, my guess, my intuition is their market share is pretty high within their local market.
You said offices, they're not our customers. And I was just laughing because my WeWork, the air conditioner would be broken at it, I'd say 2 out of every 5 days. So I can guarantee they weren't too urgent about having the air conditioners fixed. Let me ask, the office building discussion though is a nice transition to, I got 3 DMs. I think 2 people on the Twitter thread said it. Probably the most popular question, right? People see Limbach and they think, oh, a lot of the business is still GC general contracting type stuff, macro recession, commercial real estate recession, all that type of stuff. Top of mind, first question everyone asks. So how do you think about if we have soft landing, hard landing, whatever the landing we're going to have is, how do you think how that impacts Limbach?
Yeah, I mean, first of all, their end markets tend to be less economically sensitive, right? If you're talking about, higher education, not that economically sensitive. Healthcare, not that economically sensitive. Data centers, we're about to have a surge in data center spend.
I liked when you and I were talking or chatting the other day, and you said stealth AI play Limbach because somebody's got to service those data centers.
I was actually, someone messaged me that, and I was like, oh, that's funny. So I tweeted it, and then some people thought I was being serious about an AI play, and they called me an idiot. But
you weren't being serious, but you kind of were.
Yeah, kind of, not really. I just think generally they're the end markets that they play in tend to be less economically sensitive. There's a lot of, from the last few years, there's a lot of deferred CapEx, and these systems don't last forever. So there's going to be an eventual kind of deferred replacement cycle. In the meantime, we could still be there helping people extend the life of their existing equipment, improve the operating efficiency of it, which has an immediate payback, right? That's not a spend money now just for status quo. It's a spend money now. And, I was having lunch with the CEO a few weeks ago, and he was like, listen, we're still going into some of our customers. And at first they don't want to share their utility bills with us, right? For some reason, there's just a trust component where it's like, why should we be sharing our utility bills with you? But more and more of them are starting to share utility bills with LMB, and LMB is going back to them with a plan of action on how you can actually have an immediate payback on spend today that's going to reduce your cost of operating your facilities immediately. And so I think there's a lot of stuff like that where they could kind of win near-term projects and then position themselves well for the longer-term CapEx investment as well. There's MCore Comfort Systems. If you listen to their earnings calls, you look at their earnings results, they're not seeing any slowdown. They're super optimistic about kind of what their customers are telling them they're seeing. And same with LMB. I mean, if you talk to management and you ask them how things are going, they seem to see no end in sight in terms of the amount of continued growth they expect to get out of owner direct. Business has been really strong. I think it's continuing to be really strong. And of course, look, if we go into like a 2008 like recession, where everyone just has to cut spend on everything, OpEx, CapEx, and just delay, and not even do immediate payback stuff, then every business gets hurt. But the nice thing here is we're sitting on a net cash balance sheet at a low valuation. We'll be cash generative in that environment as well. And we'll be able to do acquisitions at, more attractive terms than we're even doing them at today. So you kind of have a natural hedge when you're sitting on a net cash position with a business that is now cash generative and should be continuously cash generative because of this owner direct type work that they've positioned themselves to take on. I think you're kind of hedged. If things get bad, you can deploy capital more accretively. If things are good, obviously your operating business continues to perform well.
Can you just 2 more questions, because I am really interested in this business. The first is we've mentioned several times, hey, they can do work that makes your building more efficient and you get a payback, right? And the classic would be you take an old HVAC and you install a new HVAC, and the new HVAC uses less energy, it's much more eco-efficient, all that type of stuff. I understand that example, but are there any others? Because I guess I'm sure there are, but if the way they make things more efficient is, hey, we're just going to install a new HVAC. That's more the HVAC unit that's doing the efficiency improvements.
Yeah, I don't think it's a new HVAC. I think it's improving the existing HVAC. And I think every building is different. They see the bill, they go inspect the equipment, they see if there's part of the equipment that could be replaced, not all the equipment. They could see if there's leakage, right, of cooling or heating that's causing the bill to be higher than what it should be for a building of this size, and then you could address that. I think there's lots of different things they could look at, and that's where they come in and become a trusted kind of partner to the building owners.
Last one, and then I want to move on to valuation, a few other things. Just the example we gave earlier, where Limbach comes and I'm getting ready to retire, they buy my business for 4 times EBITDA. And I'm sure they keep me on for a year or two to make sure the transition goes smooth and stuff, right? But this is in part a knowledge business. And let's say I retire and you were my general manager, right? Like, how do they keep you instead of you going off and starting, hey, Andrew was my buddy, he retired, some corporate overlord owns the business now. Why don't I just take all my people and go start my own competitor down the road? Like the classic, because they are trying to get into what is more consulting type work. And that has been the issue with a lot of these smaller consulting firms. If a private equity guy buys them, all the mid-tier people leave once the top tier people are done and they go and start their own company.
Yeah, I think compensating a whole team of these skilled professionals, especially in today's world where it's a tight labor market, it would be a big upfront investment for whoever's trying to kind of, steal that team out of the acquired asset. And then you have to, if you build it, they will commit and hope the customers actually come with you. But the customers, a lot of them have a loyalty at that point to the business that's been serving them for a long period of time. So you have to kind of invest a lot, try to get the whole team, and then try to win over the customers. I think it's easier said than done. They haven't done a bunch of these acquisitions, so I can't say go look at their history and proof is in the pudding, but that's kind of my intuition.
The one they did at the end of 2021, was it Jake
Marshall?
Yeah, it seems like that's gone pretty well.
Yeah, it's gone really well. Yeah. There were 2 earnout thresholds where I think they needed to generate like $8 million in gross profit in 2022 and then $10 million in 2023 to make both earnouts. And I think they're on track to hit both earnouts. I think it's gone really well. If they could do more acquisitions like that, I think it'd be great.
Let's quickly talk valuation. So we've said a few times the company trades at kind of 6 times EBITDA, 8 or 9 times free cash flow. EBITDA doesn't, it's funny because it has some big add backs, but they're actually add backs that you'd be okay with, except for they do have some restructuring charges in there, but we can talk restructuring charges if you want later. I guess my overall question was, how do you think about valuing this business? Because you've mentioned they've got some peers that trade at kind of 2x the multiple that they do, right? Low double digits, but those peers are also 10, 20, 30 times bigger than Limbach. So I think people might say, hey, you're comparing a tiny almond to a giant orange or something,
Yeah, I mean, there's IESC also, which is not that much larger. That also
I haven't looked at that one in a while. I remember that when who was it? The guy who had the best stock of the past 20 years.
Or something, right?
Yeah.
Gandel guy.
Tontine Capital, I think his fund was. Ooh, that's done really well recently.
It's done really well. And what's the EBITDA multiple on that? I think it's low double digits also, right?
I haven't looked at it in a while. They actually had one division that was really struggling that dragged down their entire EBITDA outlook, and I think they put it behind them. But yeah, I've got it trading at 8 or 9 times trailing EBITDA, I think.
Got it. Yeah, I thought it got into the low double digit EBITDA multiple, but that's another one it's not that much bigger than Limbach. I think the point is you build scale here, you build the diversification, the cash flow stream becomes smooth, less volatile, and it's going to grow into a higher multiple. I don't think it's going to get that higher multiple overnight, but I just think with scale, the blowups are behind them. Hopefully, I really believe the blowups are behind us. Especially since we've exited some of the troubled markets like LA, and we've moved the business more towards these smaller ticket, less working capital intensive, shorter duration projects that are just higher margin and with more visibility and less variability. So I think the blowouts are behind us. Consistent operating results, diversification through M&A, accretion through M&A. I think you naturally gain the trust of the market. And if a business can grow its free cash flow per share at a really attractive rate, I think eventually it's rewarded, without doing anything that's too risky, like taking on a lot of leverage, or doing things that are illegal or something like that. I think eventually it's rewarded with a nice free cash flow multiple. So, looking at a few years, like, I don't think it's crazy to think this trades at 12 or 15 times free cash flow, right? Like, I just don't think those are crazy. I'm not arguing for a 20 times free cash flow multiple here, but I think a lot of free cash flow per share growth through continued margin expansion, through acquisition, and then you get a little bit of multiple expansion, and that's how you end up with a home run result.
So would I be putting words in your mouth if I kind of said, look, right now it trades for 6 times EBITDA, and you kind of think it should trade for, let's call it 8 to 9 times EBITDA, which would get you into the very low double digits, free cash flow multiple, plus maybe slap an extra EBITDA turn multiple on for it to account for future accretive acquisitions done at a low multiple, as we discussed, because you're buying mom and pops and all that. Would that sound about right as a framework to you?
Yeah, I think that sounds right. I mean, I think, they could probably grow. So it depends which EBITDA number you're looking at. If you just take this last quarter where they did almost 9 million of EBITDA and annualize that, you're looking at 36 million of EBITDA on a run rate basis. The first quarter is a seasonally slower quarter for the company historically. And so I would think they'd probably do higher than 36 this year, even though that would be higher than their guidance. And I think organically they could probably take it to 60 from 36 over the next 4 or 5 years, just through continuing to mix the business towards owner direct and getting some operating leverage. And I think it really depends how much M&A you think they could do. They're going to generate a lot of cash. Now, if you think they could redeploy all that cash into M&A, then they're going to grow free cash flow per share really quickly, because M&A is super accretive. If they can't find enough attractive acquisition targets such that they either build cash on the balance sheet or have to buy back stock at 10 times free cash flow or whatever, then obviously that's much less accretive. But the way I model the business is continue to mix the business towards owner direct, redeploy all their free cash flow into acquisitions, but I have the acquisition multiples increasing over time because they need to put more money to work. So they probably have to pay up a little more to just get more deal volume. And I have free cash flow per share growing from like 250-ish this year to over $7 by 2027. So call it, 3-4 years out. And if they could actually grow from 250 to 7, I don't think it's crazy to think this trades at 85.
It's certainly, as you and I were talking, it's trading about $23 per share. If it's got $7 of free cash flow, I don't know. In today's market, maybe, there are some things that trade. But let me ask another question on M&A. So we already kind of talked about the synergies and everything. But I guess the other question on M&A is, can they do M&A? And what I mean by this is they did the Jake Marshall deal in late 2021. That deal has been great. And that was a pretty nice size deal. But they didn't do any M&A in 2022. We're 6 months into 2023 at this point, and I don't believe they've done any M&A unless I missed a press release or something. But so that's 18 months since their last deal. And we're talking here about, I'm questioning you, can they do accretive M&A? How do they make it accretive? You're building out models that they do accretive M&A. There's not a lot of proof in the pudding that they can do M&A. And I know they're asked about this on every call, but when are they going to do M&A? Are they really going to be able to grow accretively through this? Because as you said, it's not like you're really paying a lot for future accretive growth. You're not paying anything for a platform, but there's going to be a difference between if they can do consistent accretive M&A or if they just kind of limp along and have to pay out dividends and buy back stock, which I love, but that makes a big difference, especially at this size.
Yeah. I mean, look, I think without M&A, my kind of back of the envelope math says this business is worth around 35 today at probably not 10 times EBITDA, but 8 or 9 times EBITDA. It's worth 35 today. I think they can grow the value of that 35 today organically just by continuing to grow their owner direct part of their business, which would allow them to get higher margins and better free cash flow conversion. So I think you could do well. I think without doing M&A, there's a credible path to getting the stock into the 40s, I would say, over the next few years. So a double. I believe they could do M&A. They have someone dedicated full-time looking at acquisitions, Matt Katz. He's been with this business a long time. He's looking at a lot of opportunities. He's in evaluating acquisition targets. He's very disciplined. And the new CEO, Mike McCann, is also very disciplined. I don't think they're in a rush just to do deals, just to tell investors they did a deal. I think they're looking for the right cultural fit in the right market at the right valuation. and I think they're willing to be patient. The pipeline sounds big, and they're looking at a lot of things. I think they were really close on a few things, and they turned them down, towards the end of the deal processes, because they were trying to be disciplined buyers. And I think that should be a good sign to investors who, have been burned in the past by this company, which came public via SPAC, which had to take down guidance a bunch and did some things that kind of, destroyed over a short period of time their reputation with investors. They're trying to regain the credibility, and they want to do good deals, good cultures, good valuations, good end markets. And I think it sounds like there's lots of things in the pipeline. I think they've said that they're hopeful to do 1 or 2 deals a year. Obviously, we're sitting here in June and they haven't done any yet. So, can they do 2 in the back half? I don't know. Could they do 1 in the back half? I would hope at least 1. But I think they'll get a few deals done, every year. Maybe not this year, but every year going forward. The pipeline continues to grow. As you know, when we discussed RCI, when you become a known buyer, you can develop a big pipeline, but you can't force people to transact. People transact when they're ready, right? When they're getting older, they're ready to retire. They might be fearful of a downturn, so they might be more inclined to sell right ahead of the downturn. Right now, things are really good in the industry, right? We just talked about how MCOR and Comfort Systems and Limbach and IESC, their stock charts are up and to the right. Their businesses are doing well. And I think you sit there and you develop those relationships as a buyer. And when people are ready to transact, you're hopefully the buyer of choice. I think they'll be able to put capital to work. It's hard for me to say timing, just like with RCI, it's hard to say timing, but I think they'll be able to.
Let me ask one more way. So, just looking at the company, starting in 2021, you see a ton of insider buying when the stock is in the single digits. I'm looking at in March and May 2022, Michael McCann, who was the COO at the time, now he's the CEO, who I think you like a bunch and who's done a really nice job. He buys probably about $50,000 worth of shares in the $6 to $7 range. And there's a board member, Josh Horowitz, who I don't know, but who runs a fund. Do you know him? Have you talked to him at all?
I haven't spoken to him, no.
I don't know. Maybe this will make his way to.
I've had some email exchanges, but no, I haven't spoken to him.
Maybe this will make his way to him, and I'll just tell him, come on the podcast if you're running a small cap fund. It's ridiculous to have somebody running a small cap fund who hasn't. But he does some pretty consistent buying throughout last year with the stock in the $6 to $9 range, if I'm looking at these finds, right? And that's not to say it can't be a deal here, but it does strike me like, hey, last year the insiders are buying pretty aggressively in the single digits, and now they've all got 2, 3, 4 baggers on their hands, which is a nice problem to have. But it does strike me that they're not buying shares right now. Do you kind of read anything into that signal? Like maybe it was really cheap last year, and now they just kind of look and say, okay, yeah, it's fine,
Yeah, I mean, at $6, you were looking at a $60 million market cap on a business that we just said, I think it could do close to 40 million of EBITDA this year. So it was a broken SPAC with the CEO running it, I think, was having a hard time attracting new investors into the story, given the guide downs and the way they did the equity raise in 2021. I think a lot more people now are willing to kind of look at the story. And I think if you were an insider and you had the opportunity to buy at $6, you bought everything you wanted to buy because you knew how silly it was. I think you're kind of, you're topped up. I don't think you need to keep buying the whole way up, but I don't think you're going to see aggressive selling in the 20s is my guess. I have no idea. It's not like they've shared their plans with me, but
you've mentioned the equity issuance they did in 2021, and it tickles the back of my brain. I think I remember you saying something to me at the time, but I didn't really research it for this podcast. What was wrong with the equity issuance they did in 2021?
So during COVID, like we talked about, the stock went to, people thought, this might be a distressed company.
Yep.
Stock went to $3. Then it was clear that it was not going to be a distressed company. They were generating some cash. They still had some debt, but the stock was up to, $8, $9. And, I think they started evaluating an equity raise around that time. I caught wind of it. I wasn't, approached by a bank or anything, but I caught wind of it, or I suspected it. No one told me Limbach's going to do an equity raise, but someone told me, hey, a company you're interested in is looking to potentially raise some capital. Like I told the banker should really reach out to you to talk to you about this opportunity. And I suspected it might be Limbach, but so I reached out to the company and I was like, hey, I think you guys might be trying to do an equity raise. And they're, and the initial response from the first person I reached out to was, no comment. I can't discuss this with you. So I reached out to the CEO and one of the board members. And I got on the phone with the CEO and explained to him for like an hour why I thought raising at $8, unless there was something about the business that I didn't know that led the CEO to believe the business would be in distress without an equity raise. Like, of course, if you have to do an equity raise to save the business, do what you have to do. But if you're viewing this as an opportunistic raise because the stock just tripled off the lows, I think it would send a very bad signal. The stock's still very cheap, low single digit EBITDA multiple. And you know, the message the CEO gave me was, I hear you. I appreciate this feedback. Let me think about it, discuss it internally, and we'll we'll decide what we do. That was in like October, November-ish of 2020. Then a few weeks pass, no raise. I'm like, okay, good. I talked some sense into them. Hopefully some other investors talked some sense into them. And in December, they go to a conference. They're talking about how great the business is. In January, they go to another conference talking about how great the business is. This is all the former CEO talking about how great the business is, and saying he can't wait to report Q4 results, like implying the business is crushing it. And at that point, the stock's still really cheap, 35 million of EBITDA. You were still looking at 8 million shares outstanding. It was like $100 and something million market cap. So you're still looking at a stock that's like 3 or 4 times EBITDA. Stock got up to $15. People were excited. And then one day, I think it was after the close, all of a sudden an 8K comes out. They're doing an equity raise. It's already been priced. The company had 8 million shares outstanding before this raise, and they were selling 2 million shares.
Jesus. And this was all primary?
This was all primary, 2 million shares, all to new investors. They went and wall crossed new investors. They didn't contact any existing investors, and they priced the offering at $12 a share. So the stock closed at around 15. They with 8 million shares outstanding, they sold another 2 million shares. So 2 million on a base of 8 million is like a 25% increase in your share count. And everyone gets diluted by 20% at 3 times EBITDA, and no one has the opportunity to participate in their pro rata share if you've been supportive of this company and been a shareholder for a long time. So I sold most of this. They priced it, I think, around 12. Stock opened up maybe 13 or something like that. I sold a big chunk of the position. And then there were a few other things that, frustrated me, and I ended up selling out of the rest of the position and getting out entirely. I think it blew my mind that they were willing to do an equity raise. Well, first of all, that they, the initial one, I thought that they had decided not to do, but then they go and like talk up the stock and then do saying things are great. And then you do an equity raise, which implies maybe things weren't as great because you really need the cash. And you only go to new shareholders. Like, I probably would have, if I thought there was a good use of the cash, I probably would have bought stock at a higher price than 12 to support the company. Instead, I think they destroyed their credibility with investors. Again, after coming public via SPAC, after missing earnings a few times with these big project blowups, and then doing that, I think there were lots of people who look at small caps that are institutional long onlys who would not take a look at this no matter how cheap it was.
It is just funny. Just 2 things from that story. A, it's funny. They went public as a SPAC in 2016, right? And I understand being a SPAC, going public through a SPAC puts some black mark on you, especially after 2021, 2022. But it's funny, like, it's 7 years later, it's a completely different company. And still people say, oh, they went public through a SPAC, but which, it's a company that went public through a SPAC, probably lower quality, but it's also probably smaller. It's just funny how that it's going to overhang over them for the next 50 years. It'll be 2052 and be like 2016, they went public through a SPAC.
I honestly think it's starting to change. I think more people are like, I think what they needed was just a change in management.
I think 3 years should be the due date for they went public for a SPAC, where it's kind of, hey, this is season. But the other thing I was going to say is,
I do think, like, there were some big working capital swings in the business going into COVID, coming out of COVID, and they still had some big blowups they needed to work through on the general contractor side of the business. They're done working through them. 2022 was a clean cash flow year and a clean margin year. 2023 hopefully will be another one. I agree with you. If they can string together 3 years where margins are good and cash flow is good, I think they get a lot of credibility and people stop talking about the SPAC days.
The other thing I was going to say is, like, management and the board owned, before that 2 million raise, they owned approaching 20% of the stock. And, it seemed like a bad deal at the time. And in hindsight, it's probably proven to be a bad deal. The only way it probably would have been a good equity raise is if they had immediately had an acquisition to do, right? Where they say, hey, we're issuing stock at 6x to go buy an accretive acquisition at 4x. And after some cost synergies, it's 3.5. But that is not what happened. They just went out and raised equity. And it's just funny. You are probably right. They probably saw their stock up and to the right and said, hey, now's the time to do it. And COVID was a scary time. I get it. But, they own 17% of the company, and they've probably cost themselves a decent chunk of change. The stock's at 23 and they raised at 12. They cost themselves a decent chunk of change with a needless equity raise, and just shows you even high insider ownership sometimes doesn't fully align you with management, or doesn't guarantee they're going to kind of do the smart decision,
Yeah, look, there might have been more uncertainty to the business at the start of 2021, right? Like no one knew what was going to happen with the economy at that point. They did have some leverage. The business wasn't highly levered or anything. And they did have some known working capital unwinds because they did, pre-bill customers and get paid in 2020 to help their cash flow position. Yep. But if they would have flagged those things and said, we just want a little extra cushion because M&A pipeline's in good shape and just in case the economy slows, and gone to their existing investor base, I think it would have been a little better received. Instead, the way they did it just was very poorly. I mean, you price something at a huge discount, you don't let your existing investors participate, and there's no good use of proceeds where you can explain to people why you're doing it. It was just it felt almost like they wanted to get more liquidity into more flow, more liquidity, some new blue chip investors.
I call it getting compromised by a banker, right? A banker comes in and whispers in your ear and says, look, you rode the stock from 2 to 15. How smart will you look if you take a print at 12? Your investors are going to love you for taking some chips off the table, getting some liquidity. You're the next Warren Buffett. You can take this cash and use it.
Also, you're going to get some new, high quality blue chip investors.
Every time a company tells me, hey, we had to do this primary offering because we had a high quality shareholder who wanted to get added to the rate, every time they say an angel loses its wings, it's insane. I can't believe how many, who believes that? The high quality investor, if they really want to get in, instead of buying all primary at a discount, they can just go on the secondary, they can go on the stock exchange and buy it and push the shares up. Why can't they do it that way if they really want to get in?
Yeah. And listen, we have a net cash balance sheet today, which we might have had a little bit of net debt if we hadn't done that raise. But not only do we have a net cash balance sheet today, we also have 30 million of claims against general contractors from former projects gone bad that we've shown an ability to settle historically and get most of those claims. We have another 30 million of claims outstanding that hopefully settle over some period of time. Who knows? The litigation process is inherently uncertain. That's another $3 a share of additional net cash on top of the net cash we have today. Plus, the business will be generating. They've basically said 70% of EBITDA should convert to free cash flow, and so we're going to be generating $25-30 million a year of free cash flow, plus 30 million potentially in settlements of those claims. There's a lot of cash here to do attractive stuff. Even if you can't do a lot of M&A and the stock stays at these levels, I think you just buy back stock and you grow free cash flow per share that way. If the stock goes up and you can't do M&A, then maybe you sit on the cash and wait for a potential recession. I think there's just lots of things you could do to create a lot of value here over time from this starting valuation. You don't need to do M&A from this starting valuation. You just need to not do dumb things.
And now a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are. And you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. I have one more question I want to ask you, but before I get there, just on Limbach, is there anything about the story that we haven't discussed, you think we should have discussed, or that we kind of glossed over that you think we should have hit harder?
They're getting added to the Russell 2000. That's going to create some buying demand over the next few weeks. There's some warrants that expire in July that came with the SPAC. Some are 1250 strikes, some are 15 strikes. So they're all in the money at this point. Those expire in July. There will probably be some cashless exercises and sales.
One of the directors 3 or 4 days ago, cashless exercised like
Yes.
2 million of them or something.
I think it was like 100,000 shares or something like
Yeah.
that. And he had 100,000 warrants, but he cashless exercised them, so only got 30,000 shares or something like that. I think the net buying from the index addition is going to more than soak up and more the potential
warrants.
From the warrants. Other than that, no.
Let me ask you my last question, and this is a new question I've been meaning to ask the guests. So you're going to be my first guinea pig on it. But everybody. I put out a quick blog post on this, but is there anything you're doing with AI to improve or change your process? Maybe I'm just like riding the bubble and hyping on the hop train, but I personally haven't like found out any like real use cases that I think improve it or anything, but I'm just asking, anything you've tried or seen that kind of incorporated AI into your process?
No, I mean, the only real change in my process or update in thinking in my process related to AI is to try to avoid businesses that I think could be impacted over the medium term by AI. Whereas, historically, I hadn't really given it as much thought. Now I certainly am. I like owning businesses that I think have no secular issues with good balance sheets, because they're going to survive through downturns. They can deploy capital aggressively into downturns when valuations get cheap. And that long term, their value is there's durability to their enterprise value. I think Limbach checks all those boxes. Like, buildings are going to need good HVAC systems, whether it's 5, 10, 15, 20 years from now. So no secular issues. I think cyclically things are improving for their end markets right now, and they have a net cash balance sheet. So I just think when you buy something at a low valuation, generates cash, clean balance sheet with no secular issues, I think the question in your mind should be like, what will my return be? Not will I make a return here? Even at today's price up in the 20s, I still think I wonder, like, am I going to double my money here? I'm going to make 50% of my money. If I'm going to triple my money, it's hard for me to think like what can really, I mean, of course, every investment has risk. Like, things could go wrong. You could lose money if you buy this. So don't go out and buy this and reach out to me and say, you promised me I wouldn't lose money. But I like these situations where I think the skew to the upside is so much higher than the skew to the downside.
I think what you're saying, it's a low multiple and they repair air conditioners and stuff. Like, people are going to need air conditioners repaired. Maybe, as you said, maybe it's a stealth AI play. They're going to need them repaired, big buildings, no matter if AI overlords take over the world or not. I don't know if you still have it, but you used to have a position in Google. I'm guessing you still do. Have you thought about how AI, if you don't have the position in Google anymore?
I don't know.
Yeah. No, and the question was more just AI as it relates to investor. Because like, my first thought with AI was I was going to be able to be like, here's my portfolio. Find me 5 stocks that have similar characteristics that I can research and find new longs. Or like, here's a 10K. Tell me all the risk factors that like aren't in the risk factors or something. Yeah. The best I've heard is some people I think a lot of people are using AI as like an improved Google or a differentiated Google or something, but I haven't heard anyone using it in a way that as a like concentrated value fundamental investor really improves or anything the process.
Yeah, I don't know. I mean, I'm sure there are definitely use cases. If you run a really big fund with huge data feeds and you have...
they've been doing that for years, and I'm sure they get better and better at it. But that's different than what you and I do, right? We're hopefully we're focusing on a couple companies and doing well and finding interesting situations, not
I think that's right.
Long 100, short 100. Anyway, Yaron, I'm starting to ramble. I've got the dust apocalypse out here. I'm sure you've got it too. It looks like Mad Max outside, but I appreciate you coming on. Congratulations. Hope next week or the week after goes really well. And
Thank you.
I'm here for you if you need anything, and we'll chat soon.
All right. Thanks, man.
Later, buddy.
Later.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.